Markets off the lows of the day, but some of the biggest moves of the day are coming in the bond market. Let's kick it over to Yahoo Finance's Jared Blikre at the Interactive for a deeper dive. Jared.
Josh, the bond market is on fire. In fact, this is the second day here. 10-year T-note yield up 13 basis points. It was only Friday that was up another 15 or so. We're closing on 30 basis points for 2 days of price action. This is only a 1-month chart. And let me show you a 5-year chart. First of all, the current market action in context is only right here. So that's very small. Let me put a line chart on so you can see. The last time we saw a move this size in 2 days, that was actually a peak in yields, and that was in the middle of 2022. This was a decade plus high, so it was more significant that we got to that level than right now as quickly as we did. But you have to wonder, I'm going to put a 3-month chart on here. If we are to accelerate along here, beyond here, what does that mean for risk markets? Let me show you the US dollar, because that has been accelerating as well. Here's the last 2 days, big move there. Why does the dollar move along with rates, longer term rates? That's because as rates go up, that attracts US dollars. A very imprecise relationship there, but arguably we are seeing an inverse head and shoulders in the US dollar index, and this points to higher highs ahead. And so all of this potentially weighs on risk markets. And I want to show you an interesting correlation. I found this chart. This is put out by Refinitiv. This is the US dollar index going back to the very end of last year in purple versus the number of rate cuts, and this is fewer cuts as you go up. So as the dollar has been increasing ever so slightly, we have been pointing to fewer rate cuts. All of this has important implications because global currencies, global central banks, they compete just the same as everyone else. Here's the US federal fund rate going back over 15 years versus the ECB. Here's the ECB, here's the Fed, here's Japan, all the way down here. There's a very wide disparity here between these interest rates, and there was an equilibrium reached late last year based on the premise that the US is going to be cutting rates. If the US is not going to be cutting rates, that has huge implications for upsetting the global equilibrium. And I'm going to close with a heat map of the US dollar index here, where you can really see how far and how much the US dollar has been advancing. This is year to date, and this is versus all the global currencies. US dollar has appreciated 5.5% versus the Japanese yen. I'm going to show you a 3-year chart. Here's another potential cup and handle here, very loose, but if we were to complete this, this points to a materially weaker yen, and all these things can happen very quickly and come unraveling all at once. Not to be a gloom and doom here, but higher rates have higher consequences.
Jared, thank you. Appreciate it.